Hey everyone, welcome back to the channel. If you're new here, I'm Ryan, and I cover a wide range of topics that explore the fascinating world of finance, technology, and the ways they intersect with our daily lives. Whether you're a returning subscriber or a first-time viewer, it's great to have you here. Before we dive in, don't forget to hit that subscribe button if you haven't already. Give this video a thumbs up if you find it helpful, and share your thoughts in the comments below. Sharing the video with your friends and family also helps the channel grow, and I really appreciate your support. Today, we're going to tackle a critical and complex topic: how criminal money works and the methods used to launder it. From the sophisticated techniques employed to clean dirty money to the regulatory frameworks in place to combat these activities, we'll cover it all. So, stay tuned as we unpack the dark side of finance and the ongoing fight against financial crime. Criminal money, often termed dirty money, refers to funds generated through illegal activities such as drug trafficking, terrorism, embezzlement, fraud, and corruption. These illicit funds need to be disguised to appear legitimate, a process known as money laundering. This video delves into the mechanisms of criminal money and money laundering, exploring their processes, methods, and implications for the global financial system. Criminal activities can be highly lucrative, generating substantial amounts of cash. Common sources include drug trafficking. The illegal drug trade is a significant and persistent source of criminal money, generating substantial profits that often run into billions of dollars annually. This vast flow of illicit funds is facilitated by a complex and well-organized network of producers, traffickers, and distributors who operate both locally and internationally. The sheer scale of the drug trade not only fuels other criminal activities, but also has far-reaching implications for global economies and societies, exacerbating issues such as violence, corruption, and public health crises. The profits from this trade are typically used to finance other illegal ventures or are laundered to integrate them into the legitimate financial system, further complicating efforts to track and combat these criminal enterprises. Next is fraud and embezzlement. White-collar crimes, including Ponzi schemes, insider trading, and embezzlement, siphon significant amounts of money from individuals, corporations, and governments, often amounting to millions or even billions of dollars. These crimes are typically committed by individuals in positions of trust and authority, leveraging their access to sensitive financial information or exploiting weaknesses in regulatory frameworks. Ponzi schemes, for instance, lure investors with promises of high returns, only to pay earlier investors with the funds obtained from newer ones, leading to eventual collapse and substantial losses. Insider trading involves the illegal use of non-public information to gain an unfair advantage in the stock market, undermining the integrity of financial systems. Embezzlement, on the other hand, entails the fraudulent appropriation of funds or property entrusted to an individual's care, often causing long-lasting damage to organizations and eroding public trust. Collectively, these white-collar crimes not only result in financial losses, but also contribute to a broader erosion of confidence in economic institutions and legal systems. Human trafficking and smuggling are heinous crimes that generate substantial illicit profits, while also funding a wide array of other criminal enterprises. These activities involve the exploitation of vulnerable individuals, often subjecting them to forced labor, sexual exploitation, and inhumane conditions. The profits generated from trafficking and smuggling are staggering, with the illegal trade in human beings considered one of the most lucrative criminal activities globally. These funds are frequently used to finance other illicit operations, such as drug trafficking, arms smuggling, and organized crime networks. Additionally, the proceeds can be laundered through various means, integrating dirty money into the legitimate economy and further complicating law enforcement efforts. The societal impact of human trafficking and smuggling extends beyond the immediate victims, destabilizing communities, undermining economic development, and fostering environments where corruption and violence can thrive. The international nature of these crimes necessitates robust cooperation and stringent measures to combat them effectively, as they exploit gaps and weaknesses in global governance and enforcement mechanisms. Terrorism and organized crime are closely intertwined, with groups involved in these activities often engaging in a wide range of illegal enterprises to fund their operations and sustain their networks. These illicit activities can include drug trafficking, arms smuggling, human trafficking, extortion, and cybercrime, among others. The financial gains from these ventures are crucial for these groups, enabling them to purchase weapons, recruit members, conduct propaganda campaigns, and maintain the logistical infrastructure necessary for their operations. The connection between organized crime and terrorism also involves the use of corruption and violence to secure control over territories and resources, further destabilizing regions and undermining state authority. The symbiotic relationship between terrorism and organized crime poses significant challenges to global security, as it allows these groups to leverage their combined resources and expertise to evade law enforcement and counterterrorism efforts. Additionally, the convergence of these criminal activities facilitates the spread of instability, as funds generated through organized crime can be used to finance acts of terror, while terrorism can, in turn, protect and expand criminal enterprises. Combating this nexus requires a coordinated and multifaceted approach, involving international cooperation, intelligence sharing, and comprehensive strategies that address the root causes of both terrorism and organized crime. Criminal money is often considered untraceable due to its frequent origins in cash-based transactions, which lack the documentation and transparency associated with digital or formal banking transactions. This use of cash is prevalent in many illegal activities, including drug sales, illicit gambling, and human trafficking, where anonymity and the absence of a paper trail are critical to avoiding detection by authorities. Cash transactions are inherently difficult to trace because they do not leave a record of the exchange, making it challenging to link the money back to the original criminal activity or to the individuals involved. Additionally, criminals may use tactics such as structuring, breaking down large amounts of money into smaller deposits to avoid regulatory reporting thresholds, and smurfing, where numerous individuals deposit small sums into various accounts, further complicating traceability. The untraceable nature of these funds not only hinders law enforcement efforts, but also facilitates the laundering of money, as it can be more easily integrated into the legitimate economy without raising suspicions. The preference for cash transactions among criminals underscores the importance of robust anti-money laundering, AML, measures, and the need for financial institutions to be vigilant in monitoring for unusual cash flows that may indicate illegal activity. Criminal money is often voluminous, involving large sums that pose significant challenges in terms of storage and management. The sheer volume of cash generated from illicit activities like drug trafficking, human trafficking, and organized crime necessitates sophisticated methods to store and conceal it without attracting attention. Managing large amounts of physical cash is logistically difficult. It requires secure storage to prevent theft and decay, and transporting it can be risky due to law enforcement scrutiny and the potential for interception. Moreover, the physical bulk of cash can become impractical, prompting criminals to seek out ways to convert it into less conspicuous assets or to launder it into the formal financial system. To mitigate these challenges, criminals often use a variety of methods to store and manage their illicit gains. They might invest in real estate, luxury goods, or precious metals, which serve as both a store of value and a means to integrate the money into the legitimate economy. Another common strategy is to spread the funds across multiple bank accounts, often in jurisdictions with lax banking regulations, to avoid detection by regulatory authorities. This can involve the use of offshore accounts, shell companies, and complex financial instruments that obscure the true ownership and origins of the funds. The need to manage and store large sums of money without raising suspicion also drives innovation in money laundering techniques. Criminals may employ professional money launderers, use digital currencies, or exploit weaknesses in financial systems to move and disguise their wealth. This voluminous nature of criminal money not only complicates efforts to track and recover illicit funds, but also underscores the scale of the financial challenges faced by law enforcement and regulatory agencies in combating money laundering. It highlights the importance of international cooperation, advanced technology, and stringent regulatory frameworks to detect and deter the laundering of large volumes of illicit money. Large cash transactions are inherently vulnerable to detection because they often raise red flags within the financial system, attracting the attention of authorities and regulatory bodies. Financial institutions are typically required to report cash transactions above certain thresholds, known as currency transaction reports, CTRs, to prevent money laundering and other illicit activities. When criminals attempt to deposit or move large amounts of cash, they risk triggering these reports, which can lead to increased scrutiny and investigation. This heightened risk is particularly significant in countries with robust anti-money laundering, AML laws, and vigilant regulatory frameworks. To mitigate this vulnerability, criminals often resort to various tactics designed to avoid detection, such as structuring, also known as smurfing. Structuring involves breaking down large sums of money into smaller, less conspicuous amounts that fall below reporting thresholds, which are then deposited into multiple accounts over time. This method is aimed at circumventing CTR requirements and avoiding suspicion. However, financial institutions are increasingly equipped with advanced monitoring systems capable of detecting patterns of suspicious activity, including structured deposits, which can still lead to detection and reporting. Criminals may also seek to convert large amounts of cash into other forms of assets that are less conspicuous, such as purchasing high-value goods, investing in businesses, or using digital currencies. These methods help to obscure the origin of the funds and make them more difficult to trace. However, these activities themselves can sometimes raise suspicion, especially if they involve unusual or inexplicable financial behavior, such as overpayment for goods or services, or investment in sectors unrelated to the criminal's known background or legitimate business interests. The risk of detection is a significant concern for criminals, as it not only threatens their financial operations, but also exposes them to potential legal consequences. This vulnerability underscores the importance of stringent compliance measures within financial institutions and the role of regulatory authorities in monitoring and investigating suspicious transactions. It also highlights the need for continuous innovation in AML strategies to keep pace with evolving methods used by criminals to evade detection and launder their illicit gains. Money laundering is the process by which criminals disguise the original ownership and control of the proceeds of criminal conduct by making such proceeds appear to be derived from a legitimate source. The process typically involves three stages: placement, layering, and integration. Placement is an initial stage that involves introducing the illegal proceeds into the financial system. Methods include structuring. Structuring is a money laundering technique where large sums of illicit money are broken down into smaller, less conspicuous amounts and then deposited into bank accounts. This method is designed to evade detection by financial institutions and regulatory authorities who are mandated to report large cash transactions through mechanisms like currency transaction reports, CTRs, and suspicious activity reports, SARs. By keeping each transaction below the reporting threshold, criminals attempt to avoid triggering these alerts, thus making their activities harder to track. The process of structuring typically involves several steps. Initially, the large amount of illicit money is divided into multiple smaller sums. These sums are then deposited into various bank accounts, often in different financial institutions, either by the criminal themselves or through a network of accomplices, sometimes referred to as smurfs. These individuals may be unaware of the full scope of the operation and are often used to make deposits to avoid creating a pattern that could be detected by financial institutions' monitoring systems. To further obscure the trail, structured deposits might be made over a period of time, varying the amounts and frequency to prevent detection of a pattern. In some cases, structured funds are quickly withdrawn or transferred to other accounts, either domestically or internationally, adding another layer of complexity and making it even more challenging for authorities to trace the money back to its illicit source. Criminals may also use these deposits to purchase financial instruments like cashier's checks, money orders, or traveler's checks, which can then be converted into cash or used to buy goods and services, thereby further integrating the laundered money into the legitimate economy. The use of structuring poses significant challenges for law enforcement and financial institutions. While regulatory frameworks have become more stringent and sophisticated in detecting and reporting suspicious activities, the method's adaptability means that criminals continue to find new ways to exploit loopholes and weaknesses in the system. Financial institutions are required to implement robust monitoring systems and training programs to help their staff recognize signs of structuring and other money laundering tactics. Additionally, cooperation between international regulatory bodies is crucial, as structured transactions often involve cross-border elements, complicating the tracking and enforcement process. Structuring is a critical concern in the fight against money laundering because it undermines the integrity of financial systems, facilitates further criminal activity, and helps criminal organizations to finance operations and expand their influence. As such, understanding and combating structuring requires ongoing vigilance, continuous adaptation of regulatory measures, and technological innovation to stay ahead of increasingly sophisticated laundering techniques. Smurfing is a money laundering technique in which multiple individuals, often referred to as smurfs, are used to make numerous small deposits into various bank accounts, thereby avoiding detection by authorities. This method is part of the broader strategy of structuring, where large sums of illicit money are divided into smaller amounts that fall below the reporting thresholds established by financial regulations. The primary objective of smurfing is to prevent financial institutions from recognizing and reporting suspicious activity that could trigger an investigation by regulatory authorities. In practice, smurfing involves a network of individuals who are recruited to carry out the deposits. These smurfs may be compensated for their role or coerced into participating, and they often operate under the guise of legitimate account holders. Each smurf deposits a small, seemingly innocuous amount of money, typically below the threshold that would require the bank to file a currency transaction report. By using multiple smurfs across different branches or even different banks, the perpetrators spread the funds thinly enough to avoid raising suspicion. To further obscure the origin and destination of the funds, smurfing operations may include additional layers of complexity. Smurfs might use fake or stolen identities, open multiple accounts, or employ a variety of deposit methods, such as cash, money orders, or cashier's checks. The funds deposited by the Smurfs are often quickly transferred or withdrawn, sometimes funneling into offshore accounts or converted into other assets like real estate, luxury goods, or cryptocurrencies, which are harder to trace and recover. Smurfing poses a significant challenge to law enforcement and regulatory bodies due to its decentralized and fragmented nature. The use of numerous individuals to conduct transactions makes it difficult to identify and connect the dots between different parts of the operation. Financial institutions are required to implement anti-money laundering measures, including customer due diligence, transaction monitoring, and reporting mechanisms. However, the effectiveness of these measures can be undermined by the sophistication and scale of smurfing operations, which are constantly evolving to exploit new vulnerabilities in the financial system. In response to the threat posed by smurfing, regulatory authorities have increased efforts to strengthen AML regulations and improve the detection capabilities of financial institutions. This includes the development of more advanced algorithms and artificial intelligence systems to identify suspicious patterns of behavior that may indicate smurfing. Additionally, international cooperation and information sharing among financial regulators, law enforcement agencies, and financial institutions are crucial in tracking and dismantling smurfing networks, particularly those with cross-border elements. Overall, smurfing is a key tactic in the money laundering arsenal, enabling criminals to covertly integrate large sums of illegal money into the legitimate financial system. Addressing this challenge requires a comprehensive and adaptive approach, combining robust regulatory frameworks, technological innovation, and international collaboration to protect the integrity of the financial system and combat the flow of illicit funds. Bulk cash smuggling involves the physical transportation of large amounts of cash across borders, often to countries with less stringent financial regulations and weaker anti money laundering frameworks. This method is a common tactic used by criminals and organized crime groups to move illicit funds without leaving a digital trail that could be easily traced by authorities. The primary goal of bulk cash smuggling is to circumvent financial oversight and regulatory scrutiny, making it a critical component of the global money laundering process. The process typically begins with the accumulation of large sums of money generated from various illegal activities, such as drug trafficking, human trafficking, or illegal arms sales. Given the cash intensive nature of these enterprises, large amounts of physical currency need to be moved discreetly to avoid detection. Smugglers often employ a variety of concealment techniques to hide the cash during transit. These can include using specially designed compartments in vehicles, luggage, and shipping containers, or even more creative methods such as embedding cash in products or disguising it within seemingly legitimate cargo. Transport routes are carefully chosen to minimize the risk of detection. Smugglers may use remote border crossings, private airstrips, or shipping routes that bypass major checkpoints and customs inspections. The individuals involved in bulk cash smuggling operations are often highly trained in evading law enforcement and may use advanced technologies such as encrypted communications and surveillance countermeasures to avoid detection. Once the cash reaches its destination, it is often deposited in local financial institutions or converted into other assets like real estate, precious metals, or cryptocurrencies. These countries may serve as transit points or final destinations, depending on the laundering strategy. In some cases, the smuggled cash is further moved to offshore banking centers known for their bank secrecy laws and relaxed financial regulations, which provide additional layers of anonymity and protection against international regulatory scrutiny. Bulk cash smuggling poses significant challenges to law enforcement and regulatory authorities due to its covert nature and the international dimension of the crime. It often involves a complex network of participants, including local collaborators, who facilitate the smuggling process and assist in integrating the illicit funds into the local economy. The cross-border aspect of bulk cash smuggling also complicates enforcement efforts, as it requires coordination and cooperation between multiple jurisdictions, each with its own legal and regulatory frameworks. In response to the threat posed by bulk cash smuggling, many countries have implemented strict cash reporting requirements and enhanced border security measures. These measures include mandatory declaration of large cash amounts at border crossings, the use of canine units trained to detect cash, and advanced scanning technologies. International organizations such as the Financial Action Task Force also play a crucial role in setting global standards for combating money laundering and encouraging countries to strengthen their regulatory and enforcement capabilities. Despite these efforts, bulk cash smuggling remains a persistent issue, fueled by the ongoing demand for illegal goods and services and the substantial profits they generate. Combating this form of money laundering requires a comprehensive approach that includes robust domestic enforcement, international cooperation, and the continuous adaptation of regulatory frameworks to address evolving methods used by smugglers to evade detection. Purchasing high-value assets such as real estate, luxury cars, jewelry, and art is a common method used by criminals to launder money and store wealth. This method allows illicit funds to be converted into tangible assets that can appreciate in value, provide a sense of legitimacy, and offer a degree of anonymity. The appeal of this approach lies in its dual function. Not only does it enable the integration of illegal money into the legitimate economy, but it also serves as a way to hide and protect the wealth from confiscation by authorities. The process typically involves the use of large amounts of cash, which criminals prefer due to its untraceable nature. Real estate is particularly popular for money laundering because it is a high-value asset that can absorb large sums of money in a single transaction. Properties can be purchased outright, often through cash transactions or via complex financial arrangements involving shell companies or trusts. These structures obscure the true ownership and origin of the funds, making it difficult for law enforcement to trace the money back to its illegal source. In some cases, the properties are overvalued or undervalued to manipulate the amount of illicit money being laundered, a practice known as price manipulation. Luxury cars, jewelry, and art are also favored for their portability, liquidity, and ease of concealment. High-end vehicles can be bought with cash and registered under false names or corporate entities, making it challenging to establish a clear ownership link to the criminal. Jewelry and art, particularly pieces that are unique or hard to value, offer additional advantages. They can be transported easily, stored securely, and sold discreetly at a later date, often in different jurisdictions, further complicating the tracking of the laundered money. The use of these assets as a form of wealth storage allows criminals to safeguard their ill-gotten gains while enjoying the status and lifestyle associated with such high-value items. The practice of purchasing assets for money laundering purposes poses significant challenges to authorities and regulatory bodies. High-value transactions involving real estate, luxury goods, and art are often subject to less scrutiny than traditional financial transactions, especially in jurisdictions with lax regulations or enforcement. This gap in oversight provides an opportunity for criminals to exploit the system, moving large amounts of money without raising suspicion. Efforts to combat this form of money laundering include stricter regulations around cash transactions, mandatory reporting of high-value purchases, and enhanced due diligence requirements for professionals involved in real estate, art, and luxury goods markets. Furthermore, the global nature of the luxury market, combined with varying levels of regulatory enforcement, complicates the tracking and recovery of assets. International cooperation and information sharing are crucial in identifying and investigating suspicious transactions, tracing the flow of funds across borders, and seizing assets linked to criminal activities. Despite these efforts, the allure of purchasing assets as a means of laundering money and storing wealth continues to attract those seeking to conceal their illicit gains, necessitating ongoing vigilance and adaptation of regulatory measures to address this evolving threat. Layering involves creating complex layers of financial transactions to obscure the money's origin. Techniques include wire transfers. Wire transfers are a widely used method for moving money across different accounts, making them a common tool in the money laundering process. This technique involves electronically transferring funds between banks or financial institutions, often across borders. One of the key attractions of wire transfers for launderers is their speed and efficiency, enabling large sums of money to be moved quickly with minimal physical evidence. This method becomes particularly potent when used in conjunction with jurisdictions that have strict bank secrecy laws, which offer a layer of protection and anonymity to account holders. Launderers typically exploit wire transfers in several ways to disguise the origins of their illicit funds. First, they may set up numerous accounts in different countries, often under the names of shell companies or trusts. These accounts can be used to move money in a rapid series of transactions, making it challenging for authorities to trace the funds back to their original source. This technique, known as layering, involves creating a complex web of financial transactions that obscure the audit trail and increase the difficulty of tracing the laundered money. Jurisdictions with strict bank secrecy laws are particularly attractive for such operations because these laws limit the amount of information that financial institutions are required to disclose. In these jurisdictions, also known as tax havens or banking secrecy jurisdictions, banks are often prohibited from sharing information about account holders with foreign authorities. This lack of transparency makes it easier for criminals to hide their identities and the source of their funds. Moreover, these jurisdictions may have lax anti-money laundering regulations, making it harder for law enforcement agencies to investigate and prosecute money laundering activities. Wire transfers can also involve the use of correspondent banking relationships, where one bank provides services to another bank to facilitate international transactions. This relationship allows money to flow through multiple banks, sometimes in different countries, further complicating the tracking process. Criminals may use these relationships to obscure the origin of the funds, making it appear as though the money is coming from a legitimate source. In addition, they may employ nested accounts, where a smaller bank provides services through a larger bank's network to facilitate the movement of money across borders. To counter the misuse of wire transfers for money laundering, international regulatory bodies and financial institutions have implemented various measures. These include stricter know your customer requirements, enhanced due diligence for high risk transactions, and the monitoring of unusual patterns of behavior that could indicate money laundering. Financial institutions are also required to report suspicious activity to relevant authorities, which can trigger further investigation. Despite these efforts, the global nature of the banking system and the sophistication of laundering techniques continue to pose significant challenges. Criminals are constantly adapting their methods to exploit new opportunities and evade detection. As a result, combating the misuse of wire transfers for money laundering requires a combination of robust regulatory frameworks, international cooperation, and advanced technology to monitor and analyze financial transactions. This ongoing effort is crucial to maintaining the integrity of the global financial system and preventing the proliferation of criminal activity. Shell companies and trusts are sophisticated tools frequently employed in money laundering schemes. These entities are often set up to exist only on paper, without any real operational business activity, to funnel illicit money through the financial system, thereby making it difficult to trace the origins and ownership of the funds. This method exploits the legal frameworks of various jurisdictions that allow the creation of companies and trusts with minimal disclosure of their beneficial owners, thus providing a veil of anonymity to the true controllers of the assets. A shell company is a business entity that has no significant assets or operations. It exists primarily as a vehicle to conduct financial transactions, often with the sole purpose of disguising the true nature of the business dealings and the identities of the people behind them. Shell companies can be established quickly and inexpensively. And in many jurisdictions, the process requires minimal information about the company's owners or managers. This lack of transparency is a significant advantage for those looking to launder money, as it creates a complex and opaque corporate structure that can be used to hide the source of funds and the identities of the ultimate beneficiaries. Launderers use shell companies to open bank accounts, enter into financial transactions, and move money across borders. These companies often participate in a series of transactions with other shell companies, creating layers of complexity that obscure the money trail. The process of layering, which involves multiple transactions designed to confuse the origins of the funds, is central to the use of shell companies in money laundering. By transferring money between numerous shell companies, often across different jurisdictions, launderers can create a web of transactions that is difficult for authorities to unravel. Trusts are another effective vehicle for money laundering, particularly because they can be used to separate the legal ownership of assets from the beneficial ownership. In a trust arrangement, a trustee holds assets on behalf of beneficiaries according to the terms of a trust deed. This legal structure can be exploited to conceal the identity of the true owners of the assets, as the trustees are often individuals or entities distinct from the beneficiaries. Trusts can be structured in complex ways to provide additional layers of secrecy. For instance, discretionary trusts allow trustees to have significant control over the distribution of assets, often without disclosing the identity of the beneficiaries. This flexibility can be used to obscure the flow of funds and the ultimate recipients. Moreover, trusts can be set up in jurisdictions with strong privacy protections and minimal disclosure requirements, further complicating efforts to trace laundered money. The use of shell companies and trusts for money laundering presents significant challenges for regulation and enforcement. Many jurisdictions have laws that facilitate the creation of these entities with little oversight or requirement for transparency. This regulatory gap is often exploited by criminals who seek to move money across borders and into the global financial system without detection. Moreover, the use of professional intermediaries, such as lawyers and accountants, can add another layer of complexity, as these professionals are sometimes employed to set up and manage shell companies and trusts, further distancing the launderers from the illicit funds. To combat the misuse of shell companies and trusts, international bodies like the Financial Action Task Force have advocated for stronger regulations and greater transparency in the ownership and control of legal entities. This includes the implementation of beneficial ownership registries, which require the disclosure of the true owners of companies and trusts. Additionally, financial institutions are encouraged to perform enhanced due diligence when dealing with customers who use these structures, particularly those from high-risk jurisdictions. Despite these efforts, the global nature of the financial system and the varying levels of regulatory rigor across jurisdictions make it challenging to effectively control the use of shell companies and trusts in money laundering. As criminals continually adapt their methods to exploit legal and regulatory loopholes, ongoing international cooperation and coordination are crucial in the fight against financial crime. This includes sharing information, harmonizing regulations, and building capacity among law enforcement and regulatory bodies to better detect and prevent the misuse of these entities for illicit purposes. Trade-based money laundering is a sophisticated method of laundering illicit funds, utilizing the international trade system to disguise the movement of money and goods. This technique involves the manipulation of invoices and other trade documentation to misrepresent the price, quantity, or quality of goods and services. By over-invoicing or under-invoicing transactions, launderers can move money across borders while concealing the true nature of the funds. TBML exploits the vast volume of global trade, making it challenging for authorities to detect illicit activities among legitimate transactions. In over-invoicing, the seller issues an invoice for an amount significantly higher than the actual value of the goods or services. The buyer pays the inflated price, and the excess amount is effectively transferred to the seller's account, often in a different jurisdiction. This excess payment represents laundered money, as it is falsely justified by the invoice. Over-invoicing allows criminals to move large sums of money while making it appear as part of a legitimate business transaction. For example, a company might export a low-value product but invoice it at a much higher price. The receiving company pays the inflated invoice amount, effectively transferring excess funds to the exporting company's account. This technique is particularly effective in high-value industries such as electronics, jewelry, and luxury goods, where the actual value of the goods can be easily manipulated. Conversely, under-invoicing involves issuing an invoice for less than the actual value of the goods or services. The buyer pays the lower amount, but the seller receives additional payments outside the official channels, often in cash or through informal financial networks. This method can be used to repatriate funds or move money without generating a record of the full transaction value. Under-invoicing can also be employed to evade taxes and customs duties, compounding the illegality of the practice. For instance, a company may import high-value machinery but declare a lower value on the invoice to reduce the amount of duty payable. The balance is settled off the books, providing the importer with a way to move money covertly. This practice not only facilitates money laundering, but also undermines tax revenue and distorts market competition. Trade-based laundering can also involve other techniques such as multiple invoicing, issuing multiple invoices for the same shipment of goods or services to justify multiple payments. This method can be used to move money multiple times, complicating the tracking process. Phantom shipping, reporting the shipment of goods that never exist, or over-reporting the quantity shipped. This technique involves creating false shipping documents and invoices to justify the transfer of funds. Misrepresentation of goods, falsifying the description of goods or services, such as declaring high-value goods as low-value items. This tactic can evade detection by misrepresenting the nature of the trade. Detecting and preventing trade-based money laundering is particularly challenging due to the complexity and volume of international trade. Legitimate businesses and trade transactions often involve multiple jurisdictions, currencies, and regulatory frameworks, creating numerous opportunities for criminals to exploit. Moreover, the use of intermediaries, such as brokers and freight forwarders, can obscure the true nature of transactions and complicate the investigation. To combat TBML, customs and regulatory authorities worldwide are increasingly focusing on improving transparency and data sharing. This includes initiatives to enhance the accuracy and availability of trade data, such as detailed invoice reporting and verification of the value and nature of goods being traded. Financial institutions are also being urged to implement stricter due diligence procedures, particularly in industries and regions known to be vulnerable to TBML. The international nature of trade-based money laundering necessitates robust cooperation between countries, including the harmonization of laws and regulations, and the sharing of intelligence and investigative techniques. Organizations such as the Financial Action Task Force provide guidance and set standards to help countries develop effective anti-money laundering frameworks. Additionally, advances in technology, such as data analytics and machine learning, are increasingly being leveraged to detect anomalies and patterns indicative of TBML. Overall, trade-based laundering is a complex and evolving challenge that requires a coordinated and multifaceted response from governments, financial institutions, and the international community. By improving regulatory oversight, enhancing data transparency, and fostering international cooperation, the global community can better combat this insidious form of financial crime. Investing in legitimate businesses is a common strategy for laundering illicit funds, providing criminals with a means to integrate dirty money into the legitimate economy. This method involves channeling illegal funds into seemingly legitimate business ventures, such as retail shops, restaurants, real estate developments, or other cash-intensive businesses. By doing so, launderers can make the illicit funds appear as legitimate business income, thereby obscuring the true origins of the money. One of the key tactics in this form of money laundering is the use of falsified invoices and receipts. Criminals may overstate the revenues of a business or inflate the costs of goods and services. For instance, a restaurant might report higher than actual sales, claiming the additional revenue as legitimate earnings. This artificial inflation of income makes it difficult for authorities to distinguish between genuine business operations and money laundering activities. Similarly, businesses might use fraudulent expenses to justify the outflow of cash, making it appear as though the money is being spent on legitimate business activities rather than being siphoned off for illicit purposes. Another approach involves the acquisition or establishment of cash-intensive businesses, which provide a convenient front for laundering money. Businesses such as nightclubs, car washes, and convenience stores are particularly attractive because they typically handle large amounts of cash, making it easier to blend illicit funds with legitimate earnings. The daily influx of cash can mask the introduction of laundered money, making it difficult for auditors and regulators to detect anomalies. These businesses also allow for the commingling of legal and illegal revenues, further complicating efforts to trace the source of funds. Investing in real estate is another prevalent method for laundering money. Real estate transactions involve large sums of money and can be structured in complex ways to obscure the true ownership of properties. Criminals might purchase properties using illicit funds and then sell them at a later date, claiming the proceeds as legitimate capital gains. Alternatively, they may invest in property development projects using multiple layers of companies or trusts to conceal their involvement and launder money through seemingly legitimate business expenses and revenue streams. The real estate sector's susceptibility to price manipulation also provides an avenue for laundering, as properties can be overvalued or undervalued to facilitate the movement of funds. Private equity and investment funds are another avenue for laundering money through legitimate businesses. Criminals may invest in these funds, which then channel the money into various business ventures. The complex structure of these investments, often involving multiple jurisdictions and layers of ownership, can obscure the true source of the funds. Additionally, investment in startups or small businesses, which may lack stringent financial controls and oversight, provides another opportunity to introduce illicit funds into the financial system. Challenges in detection and regulation. Detecting and regulating the laundering of money through legitimate businesses is challenging due to the integration of illicit funds into lawful economic activities. Financial institutions and regulatory bodies are tasked with identifying and reporting suspicious activities, but distinguishing between genuine business transactions and laundering schemes can be difficult, especially in industries where cash transactions are common. To address these challenges, regulatory frameworks emphasize the importance of customer due diligence and enhanced due diligence for high-risk customers and sectors. Financial institutions are required to verify the identities of their customers, understand the nature of their business activities, and monitor transactions for unusual or suspicious behavior. This includes scrutinizing high-value transactions, frequent transfers, or inconsistent revenue patterns that may indicate money laundering. The use of technology, such as data analytics and machine learning, is increasingly being adopted to detect patterns indicative of money laundering. These technologies can analyze large data sets to identify anomalies and trends that human analysts might miss, improving the effectiveness of AML efforts. However, the sophistication and adaptability of criminals mean that regulatory measures must continually evolve to address new methods and tactics. International cooperation. Given the global nature of business and finance, international cooperation is crucial in combating the laundering of money through legitimate businesses. Laundered funds often move across borders, making it essential for countries to collaborate on regulatory standards and enforcement. Organizations like the Financial Action Task Force play a key role in setting global standards for AML and promoting cooperation among countries. Investing in legitimate businesses as a means of laundering money is a sophisticated and pervasive issue that poses significant challenges to financial regulators and law enforcement agencies. While efforts to detect and prevent this type of laundering have advanced, ongoing vigilance, regulatory innovation, and international collaboration are essential to mitigate the risks and protect the integrity of the global financial system. In the final stage, the laundered money is integrated into the legitimate economy. The money now appears to be derived from legal sources and can be used freely. Methods include investing in legitimate ventures. Investing in legitimate ventures is a sophisticated and common method used in the final stage of money laundering, known as integration. This stage involves using cleaned money, which has been processed through various laundering techniques, to invest in legal and seemingly unrelated financial instruments and business opportunities. The aim is to blend illicit funds with legal economic activities, thereby making the origins of the money difficult to trace and providing a veneer of legitimacy to the proceeds. One of the primary avenues for integrating laundered money is through the financial markets. Criminals often invest in stocks, bonds, mutual funds, and other securities. These investments offer several advantages. They can be made in large amounts, are easily liquidated, and provide returns that can be reinvested or further laundered. Additionally, the complex and often opaque nature of financial markets, especially in jurisdictions with strong privacy laws, helps conceal the true ownership and origins of the funds. For instance, investments can be made through offshore accounts or shell companies, further distancing the illicit money from its source. Real estate is another popular vehicle for laundering money, particularly in urban areas with booming property markets. Investing in real estate not only allows for the significant outlay of capital, but also offers the potential for substantial returns. Criminals might purchase luxury properties, commercial buildings, or land, often paying in cash or through complex financing arrangements that hide the true source of funds. Real estate investments can be held long-term to appreciate in value, rented out to generate legitimate income, or sold to generate profits that appear clean. In some cases, launderers may engage in property flipping, buying properties at lower prices, renovating them, and selling them at higher prices to further obscure the money trail. In addition to financial markets and real estate, investing in businesses is another effective way to integrate illicit funds. Criminals may acquire existing businesses, start new ventures, or invest in startups. These businesses can range from retail and hospitality to manufacturing and technology, depending on the launderer's interests and the potential for disguising illegal profits. Investing in businesses not only provides a cover for the laundered money, but also creates an ongoing revenue stream, which can be presented as legitimate business income. In some cases, businesses may be used as fronts, with actual operations taking a back seat to the primary purpose of moving and integrating laundered funds. Moreover, the use of trusts, offshore financial centers, and investment vehicles, such as hedge funds or private equity funds, can further obscure the ownership and control of investments. These entities can provide layers of separation between the laundered money and the launderer, making it difficult for law enforcement to trace the money back to its criminal origins. Offshore jurisdictions with lax regulatory standards or strong privacy protections are particularly attractive for these purposes, as they can shield the identities of the true beneficiaries and the sources of the funds. The integration of laundered money into legitimate ventures presents significant challenges for regulatory and law enforcement agencies. The legitimate nature of the investments makes it difficult to distinguish between lawful financial activities and those involving illicit funds. To address these challenges, regulators impose stringent due diligence requirements on financial institutions, real estate agents, and other professionals involved in high-value transactions. These requirements include verifying the identities of investors, assessing the sources of funds, and reporting suspicious activities to authorities. Advanced analytics and data sharing initiatives are also crucial in identifying and investigating potential money laundering schemes. By analyzing financial transactions and cross-referencing them with public records, authorities can detect patterns that may indicate the use of legitimate investments to launder money. International cooperation and information exchange are essential in this regard, as money laundering often involves cross-border transactions and the use of global financial networks. Investing in legitimate ventures is a key strategy in the money laundering process, allowing criminals to integrate illicit funds into the economy while concealing their true origins. This method's complexity and sophistication underscore the need for robust regulatory frameworks, vigilant monitoring, and international collaboration to detect and disrupt money laundering activities effectively. As financial markets and business practices evolve, so too must the techniques and tools used by regulators and law enforcement to combat this global challenge. Luxury purchases represent a sophisticated method of laundering money, where criminals use illicit funds to buy high-value items such as luxury goods, art, jewelry, antiques, or collectibles. This strategy serves multiple purposes. It allows launderers to convert dirty money into physical assets, which can then be resold or held as a store of value. The nature of these items, which often come with a degree of privacy and a lack of stringent regulatory oversight, makes them particularly attractive for those looking to conceal the origins of their wealth. The art market is especially vulnerable to money laundering due to its opacity and the subjective nature of art valuation. High-end art pieces can be bought and sold with relative anonymity, often through private sales or at auctions, where the identities of buyers and sellers are not disclosed. This lack of transparency is compounded by the use of intermediaries, such as art dealers or galleries, who may facilitate transactions without fully verifying the provenance of the funds. Once purchased, art can serve as a mobile and discrete store of value, easily transported across borders or stored in free ports. Secure storage facilities that offer tax advantages and privacy protections. The appreciation potential of art also makes it a valuable asset for laundering purposes. Criminals can purchase artworks and later sell them at a profit, thus introducing the proceeds into the legitimate financial system under the guise of legitimate business transactions. This process not only obscures the original source of the funds, but also allows the launderer to enjoy the status and aesthetic appeal associated with owning fine art. Luxury goods, including high-end watches, designer clothing, and jewelry, are another popular choice for money laundering. These items are often bought in cash, making it easier to integrate illicit funds without raising suspicion. The high value-to-weight ratio of jewelry and luxury watches, for instance, makes them convenient for transporting and concealing large sums of money. Additionally, these items can be easily liquidated or pawned, providing a quick means of converting assets back into cash if needed. Jewelry and precious stones are particularly prone to laundering activities due to their intrinsic value and the relative ease of valuation manipulation. Diamonds, for example, can be graded and priced differently based on subtle differences in quality, which can be exploited to justify price discrepancies. The international nature of the gemstone trade, often involving jurisdictions with lax regulatory oversight, further complicates efforts to track and regulate the movement of funds associated with these goods. Purchasing luxury vehicles, such as high-end cars, yachts, or private jets, is another method employed by launderers. These vehicles not only serve as symbols of wealth and status, but also as valuable assets that can be resold or used as collateral for loans. In many cases, these purchases are made through shell companies or offshore accounts to mask the true identity of the buyer and the source of the funds. The luxury vehicle market, like real estate, can be subject to price manipulation, making it another effective tool for laundering money. The regulation of the luxury goods market presents significant challenges. Unlike financial institutions, which are subject to stringent anti-money laundering regulations, dealers in high-value goods often face less rigorous scrutiny. This regulatory gap can be exploited by criminals who seek to launder money through the purchase of luxury items. Efforts to address this issue include the implementation of stricter due diligence requirements for dealers in precious metals, stones, and art, as well as greater oversight of auction houses and galleries. However, the global and fragmented nature of these markets makes uniform enforcement difficult. International cooperation and information sharing are crucial for tracking the movement of high-value goods and identifying suspicious transactions. Additionally, technological advancements, such as blockchain and other digital ledger technologies, offer potential solutions for increasing transparency and traceability in these markets. Luxury purchases provide an attractive and effective means for laundering money, allowing criminals to integrate illicit funds into the legitimate economy, while enjoying the benefits of valuable and prestigious assets. Addressing the challenges posed by this form of money laundering requires a combination of enhanced regulatory frameworks, vigilant monitoring, and international collaboration. As the market for luxury goods continues to grow and evolve, so too must the strategies for detecting and preventing the misuse of these assets for illicit purposes. False loans are a deceptive method used in money laundering, involving the creation of fictitious loans that allow criminals to move illicit funds into legitimate financial channels under the guise of loan repayments. This tactic is part of the broader strategy of layering in money laundering, where the goal is to disguise the origin of the money and make it appear as though it has been legally obtained. The process typically begins with the establishment of shell companies or entities, which serve as fronts for the illicit activity. These companies, which may exist only on paper, ostensibly engage in business transactions, including lending and borrowing money. A false loan arrangement is set up where one of these companies loans a substantial sum to another entity, which could be another shell company, a complicit business, or a criminal associate. The terms of the loan, including interest rates and repayment schedules, are usually fabricated to align with the needs of the laundering operation. Once the loan agreement is in place, the borrowed funds are transferred, ostensibly as part of the loan, but in reality, these funds are often the proceeds of criminal activities such as drug trafficking, fraud, or embezzlement. The receiving entity then makes periodic repayments, which are recorded as legitimate financial transactions. These repayments can be structured over time to reduce suspicion and can include inflated interest payments that further launder the illicit money. To enhance the appearance of legitimacy, the loans may be documented with forged or fraudulent paperwork, including fake financial statements, loan agreements, and transaction records. These documents are designed to withstand scrutiny from auditors and regulators, making it challenging for authorities to detect the fraudulent nature of the loans. The use of professional intermediaries, such as lawyers or accountants, can add an additional layer of credibility and complexity to the scheme, as these individuals may be used to draft the documentation and facilitate the transactions. False loans can also be used in conjunction with international financial structures. For example, loans might be made between entities in different countries using offshore accounts or financial centers with strict bank secrecy laws to further obscure the money trail. This international dimension not only complicates detection, but also poses significant challenges for law enforcement agencies, as it requires cross border cooperation and coordination to trace and investigate the flow of funds. One of the key advantages of using false loans in money laundering is the ability to justify large cash flows as part of normal business operations. This makes it harder for financial institutions and regulatory bodies to identify the transactions as suspicious, especially if the laundering entities have a history of legitimate business activities. Moreover, the repayments can be funneled back into the criminal's personal accounts or other controlled accounts, effectively laundering the money and making it available for use without raising red flags. However, the use of false loans is not without risk. If discrepancies in the paperwork are discovered, or if the entities involved cannot demonstrate the capacity to make legitimate repayments, the scheme can unravel. Additionally, increasingly stringent anti-money laundering regulations and the use of advanced data analytics by financial institutions are improving the ability to detect anomalies that may indicate money laundering activities. To combat the misuse of loans in money laundering, regulators and financial institutions are implementing stricter due diligence requirements. This includes verifying the identity and financial health of borrowers and lenders, scrutinizing the terms and conditions of loans, and ensuring that the source of funds for repayments is legitimate. Enhanced monitoring and reporting requirements for large or unusual transactions also play a critical role in detecting and preventing the laundering of money through false loans. False loans represent a sophisticated and versatile tool in the arsenal of money launderers, allowing for the integration of illicit funds into the legitimate financial system under the cover of legitimate business transactions. Addressing this challenge requires ongoing vigilance, robust regulatory frameworks, and international cooperation to detect and disrupt these schemes, protecting the integrity of the financial system and deterring criminal activity. The primary motivation for money laundering is to enjoy the proceeds of criminal activities without attracting legal consequences. However, other motivations include avoiding detection. The primary objective of money laundering is to obscure the criminal origins of illicit funds, making it difficult for law enforcement agencies and regulatory authorities to trace the money back to illegal activities. Launderers employ a variety of sophisticated techniques and strategies to achieve this goal, which are collectively aimed at avoiding detection, minimizing the risk of legal action, and ensuring that the laundered money can be used freely without raising suspicion. One of the key strategies for avoiding detection is the use of complex layering techniques. This involves breaking down large sums of money into smaller, less noticeable amounts and conducting a series of financial transactions designed to conceal the money's origins. These transactions may include multiple transfers between accounts, often across different banks and jurisdictions, which can create a confusing and opaque trail. By spreading the transactions over time and through various financial instruments, launderers make it challenging for authorities to track the money's movement and identify its source. Another common tactic is the use of shell companies, trusts, and other corporate structures that can obscure the identity of the true owners of the funds. These entities, often established in jurisdictions with lax regulatory standards and strong privacy protections, provide a layer of anonymity that shields the launderers from scrutiny. Shell companies, in particular, can be used to hold assets, make investments, or conduct business transactions, all while hiding the beneficial owner's identity. Trusts can add another layer of complexity as they separate legal ownership from beneficial ownership, making it even more difficult to trace the money. The use of cash-intensive businesses, such as restaurants, casinos, or retail outlets, is another method for avoiding detection. These businesses naturally handle large volumes of cash, which can be mixed with illicit funds to make it appear as legitimate business income. This practice, known as commingling, allows launderers to integrate dirty money into the legitimate economy while reducing the risk of attracting attention. In some cases, these businesses may report inflated revenues or manipulate financial records to further disguise the origins of the funds. Cross-border transactions and offshore banking also play a significant role in avoiding detection. By transferring money through offshore accounts, often located in tax havens or banking secrecy jurisdictions, launderers can exploit regulatory gaps and differences in financial oversight. Offshore financial centers provide a level of confidentiality that makes it difficult for authorities to access information about account holders and transactions. Moreover, the use of international trade-based laundering techniques, such as over-invoicing or under-invoicing goods, can facilitate the movement of money across borders under the guise of legitimate trade. Digital currencies and emerging technologies present new challenges for detection and regulation. Cryptocurrencies, in particular, offer a degree of anonymity and ease of transfer that is attractive to launderers. While many cryptocurrency exchanges now comply with anti-money laundering regulations, the pseudonymous nature of these transactions and the use of mixers or tumblers to obscure the origin of digital coins make it difficult to trace the flow of funds. Additionally, the rise of decentralized finance platforms, which operate without traditional intermediaries, further complicates efforts to monitor and regulate transactions. To counter these sophisticated methods, law enforcement and regulatory bodies employ a range of measures aimed at detecting and preventing money laundering. Financial institutions are required to implement comprehensive AML programs, including customer due diligence, ongoing transaction monitoring, and the reporting of suspicious activities. Advanced data analytics, artificial intelligence, and machine learning are increasingly used to detect patterns indicative of money laundering, helping to identify high-risk transactions and entities. International cooperation is also crucial in combating money laundering, as criminal networks often operate across borders. Organizations like the Financial Action Task Force set global standards for AML measures and promote international collaboration among countries. Information sharing between financial institutions, regulators, and law enforcement agencies is essential for tracking illicit funds and disrupting laundering networks. Avoiding detection is a central goal of money laundering, requiring a sophisticated and evolving set of strategies to obscure the origins of illicit funds. The ongoing challenge for authorities is to adapt to these methods, strengthen regulatory frameworks, and enhance cooperation to protect the integrity of the financial system and bring perpetrators to justice. Laundered money serves as a critical resource for funding further criminal activities, creating a self-sustaining cycle of crime and laundering that perpetuates illegal enterprises. The infusion of clean money into criminal organizations not only enables the continuation of illicit activities, but also provides the financial stability needed to expand operations, recruit new members, and innovate in response to law enforcement tactics. One of the primary uses of laundered money is to reinvest in the same or related criminal enterprises that generated the funds. For instance, in drug trafficking, the profits from drug sales are often laundered and then used to purchase more drugs, pay for transportation and logistics, bribe officials, and acquire advanced technology or weapons. This reinvestment allows the criminal organization to maintain and grow its market share, increase production and distribution capacity, and further entrench itself in the illicit drug trade. In addition to directly supporting the operations of criminal enterprises, laundered money can be used to finance other types of criminal activities. This diversification can include everything from human trafficking and arms smuggling to cybercrime and counterfeit goods production. For example, a criminal group involved in drug trafficking might use laundered funds to finance a human trafficking ring, leveraging existing logistics networks and corrupt relationships to expand into new criminal markets. The diversification of criminal activities not only maximizes profits, but also spreads risk, making it harder for law enforcement to dismantle the organization as a whole. Laundered funds also play a significant role in corruption and political influence. Criminal organizations often use these funds to bribe public officials, law enforcement, and judicial personnel, ensuring a degree of protection and complicity that shields their operations from scrutiny and prosecution. This corruption can extend to the political arena, where laundered money is used to fund political campaigns, gain influence over policy decisions, or secure contracts and licenses. The result is a weakening of the rule of law and the erosion of public trust in governmental institutions, which further facilitates the activities of criminal networks. The availability of substantial financial resources through laundering also allows criminal organizations to innovate and adapt to changing circumstances. For instance, they can invest in new technologies, such as advanced encryption methods or cyber attack capabilities, which enhance their ability to conduct criminal activities while evading detection. They can also develop more sophisticated laundering techniques, such as using cryptocurrencies, trade-based laundering, or complex financial instruments to further obscure the origins of their funds and integrate them into the legitimate economy. Moreover, the cycle of crime and laundering can have broader socioeconomic impacts. The infiltration of illicit money into legitimate businesses and markets can distort economic activity, create unfair competition, and undermine legitimate enterprises. It can also contribute to social inequality, as wealth accumulated through criminal means is often concentrated in the hands of a few, exacerbating disparities and potentially leading to social unrest. The reinvestment of laundered money into criminal activities also poses significant challenges for law enforcement and regulatory authorities. The complexity and global nature of these networks require extensive resources, international cooperation, and advanced investigative techniques to disrupt. Furthermore, the legal and financial sophistication of these organizations, often supported by professional intermediaries such as lawyers, accountants, and bankers, adds additional layers of difficulty to enforcement efforts. To combat the funding of further crimes through laundered money, authorities must focus not only on detecting and seizing illicit funds, but also on dismantling the networks that enable their circulation. This includes targeting the financial infrastructure that supports these activities, such as shell companies, offshore accounts, and informal money transfer systems. Enhanced regulatory frameworks, robust AML compliance programs, and vigilant monitoring by financial institutions are essential components of this strategy. Additionally, international cooperation and intelligence sharing are crucial for tracking and disrupting the flow of illicit funds across borders. The use of laundered money to fund further crimes represents a significant and ongoing threat to global security and economic stability. By perpetuating a cycle of criminal activity and laundering, these funds enable criminal organizations to thrive and expand, undermining efforts to combat organized crime, corruption, and other illicit activities. Addressing this challenge requires a comprehensive and coordinated response that includes strengthening legal and regulatory frameworks, enhancing enforcement capabilities, and fostering international collaboration to disrupt the financial networks that sustain criminal enterprises. Criminal organizations often seek to achieve economic stability by legitimizing their illicit funds through money laundering. This financial stability is crucial for the sustainability and expansion of their operations. By integrating illicit gains into the legitimate economy, these organizations not only safeguard their assets from seizure and forfeiture, but also create a more predictable and secure financial environment in which to operate. This process enables them to diversify their investments, ensure a steady cash flow, and reduce dependency on continuous illegal activities for immediate liquidity. The legitimacy conferred upon laundered money allows criminal organizations to establish a facade of lawful business operations, which serves multiple purposes. First, it provides a cover for ongoing criminal activities by blending illegal proceeds with legitimate business revenues. For instance, a crime syndicate might own restaurants, construction companies, or real estate firms that not only serve as fronts for laundering money, but also generate legitimate income. This mix of legal and illegal income streams complicates the efforts of law enforcement agencies to disentangle and identify the true sources of the organization's wealth. Moreover, the establishment of legitimate businesses allows criminal organizations to invest in a wide range of industries, spreading risk and securing financial returns from diverse sources. This diversification can include sectors such as real estate, hospitality, retail, and finance, which are not only lucrative, but also provide numerous opportunities for further laundering activities. By placing laundered funds into legitimate businesses, these organizations can stabilize their cash flow, hedge against market fluctuations, and benefit from the growth and profitability of the mainstream economy. Financial stability also empowers criminal organizations to engage in strategic planning and long-term investment, enhancing their resilience against economic downturns and legal interventions. With a stable financial base, they can afford to invest in infrastructure, technology, and human resources, which are critical for the efficient and effective operation of their illegal enterprises. For example, a drug cartel with substantial legitimate assets can fund research into new drug formulations, invest in more sophisticated trafficking methods, or pay for the protection and loyalty of members and affiliates. Additionally, legitimizing illicit funds through investments in legitimate ventures facilitates access to credit and financial services that are typically unavailable to purely illegal enterprises. Banks and financial institutions, often unaware of the criminal origins of the funds, may provide loans, credit lines, and other financial products to these seemingly legitimate businesses. This access to capital enables criminal organizations to expand their operations, acquire new assets, and enter new markets, further entrenching their presence in both the criminal and legitimate economies. Another significant advantage of achieving economic stability through money laundering is the ability to influence and corrupt political, legal, and economic systems. Financially stable criminal organizations are better positioned to bribe public officials, law enforcement agents, and judicial authorities, securing favorable treatment or immunity from prosecution. They can also engage in political donations, lobbying, and other forms of influence peddling to shape laws and regulations to their advantage. This corruption and undue influence can undermine the rule of law, weaken governance, and create environments in which criminal organizations can operate with relative impunity. Furthermore, the economic stability provided by legitimized funds enhances the reputation and social standing of criminal organizations and their members. By participating in legitimate business activities and contributing to economic growth, they may gain a level of acceptance or even respectability in certain circles. This can lead to a normalization of their presence and activities within society, making it more challenging for authorities to target them without facing public or political backlash. The process of legitimizing illicit funds is a critical strategy for criminal organizations seeking economic stability and the capacity to expand their operations. By integrating dirty money into the legitimate economy, they not only secure their financial future, but also enhance their ability to operate and influence across multiple spheres of society. Combating this phenomenon requires a comprehensive approach that includes stringent regulatory measures, robust financial monitoring, and international cooperation to detect and disrupt the laundering of criminal proceeds. Without such efforts, criminal organizations will continue to exploit the financial system to sustain and grow their illegal enterprises, posing ongoing threats to global security and economic integrity. Money laundering has far-reaching implications for the global economy, financial institutions, and society at large. Money laundering can significantly distort financial markets, with particularly pronounced effects in sectors such as real estate and luxury goods. The introduction of large amounts of illicit funds into these markets can lead to inflated prices, creating artificial economic conditions that do not reflect true supply and demand dynamics. This distortion not only affects market stability, but also has broader economic and social consequences. In the real estate market, money laundering can manifest through the purchase of high-value properties with illicit funds. When criminals invest substantial amounts of laundered money in real estate, it can drive up property prices, especially in high-demand areas or cities known for luxury real estate. This price inflation occurs because launderers often pay above-market rates or purchase properties in bulk, which skews the market valuation. As a result, legitimate buyers may find it increasingly difficult to afford property, leading to reduced affordability and potentially exacerbating housing crises in certain regions. The distortion of real estate prices can also lead to broader economic consequences. For instance, inflated property values can result in higher property taxes and rental rates, impacting both residential and commercial tenants. This situation can strain household budgets and business operating costs, leading to decreased disposable income and potentially dampening local economic activity. Moreover, inflated real estate prices can create a bubble, which, if burst, can lead to significant economic downturns, financial instability, and loss of wealth for property owners and investors. The luxury goods market is similarly affected by money laundering. The influx of illicit funds into the market for high-end items such as designer clothing, jewelry, luxury cars, and art can artificially inflate prices. Launderers often purchase luxury goods not only for personal enjoyment, but also as a means of storing and transferring wealth. The demand generated by these purchases can push prices beyond the reach of average consumers, distorting market prices and creating barriers to entry for legitimate buyers. Furthermore, the luxury market's distortion can have cultural and social implications. As luxury goods become more associated with criminal activities and money laundering, they may lose their status symbols' cachet and desirability among law-abiding consumers. This association can tarnish the reputation of luxury brands and reduce consumer trust, impacting sales and brand equity. The distortions caused by money laundering extend beyond specific markets and can influence broader economic indicators and financial stability. For example, when illicit funds are invested in stock markets or financial instruments, they can create volatile market conditions, as these investments are often not based on sound economic fundamentals, but rather on the need to launder money. Such volatility can lead to unpredictable market swings, affecting investor confidence and the stability of financial markets. Moreover, money laundering can distort competition and economic fairness. Businesses that benefit from laundered funds may gain an unfair competitive advantage over their rivals, allowing them to undercut prices, invest more in marketing, or expand more rapidly than their competitors. This distortion can lead to market monopolies or oligopolies, reducing competition, innovation, and consumer choice. Additionally, businesses that engage in or facilitate money laundering may corrupt local economies and governance, undermining the rule of law and economic integrity. To mitigate the market distortions caused by money laundering, regulatory authorities and financial institutions must enhance their monitoring and reporting mechanisms. This includes implementing rigorous due diligence processes, particularly in high-risk sectors like real estate and luxury goods. Governments and international bodies should also work together to standardize regulations and improve transparency in these markets, making it more difficult for illicit funds to be integrated without detection. Money laundering has profound and far-reaching impacts on market dynamics, distorting prices, affecting economic stability, and undermining fairness and competition. Addressing these distortions requires a comprehensive and coordinated effort from governments, regulators, financial institutions, and the private sector. By strengthening anti-money laundering frameworks, enhancing transparency, and fostering international cooperation, it is possible to mitigate the negative effects of money laundering on markets and society at large. The influx of illicit funds into the economy, often through money laundering activities, can lead to significant economic inefficiencies. These inefficiencies arise from the misallocation of resources and the creation of an uneven playing field for legitimate businesses. This distortion of economic fundamentals not only hampers the efficient functioning of markets, but also undermines the overall health and stability of the economy. One of the primary ways in which illicit funds cause economic inefficiencies is by distorting investment patterns. When large sums of laundered money are injected into the economy, they can be directed towards sectors or projects that do not align with the real needs or priorities of the economy. For example, an overinvestment in luxury real estate or speculative assets driven by money laundering can divert resources away from more productive sectors such as manufacturing, technology, or infrastructure development. This misallocation can result in an imbalance in the economy, where certain sectors are overcapitalized, while others lack necessary investment, leading to inefficiencies in resource utilization and economic growth. Moreover, the presence of laundered money can artificially inflate asset prices, including real estate, stocks, and other commodities. This inflation not only creates bubbles in these markets, but also misleads investors and policymakers about the true economic conditions. It can lead to overvaluation of assets and a subsequent misallocation of investment as capital flows into inflated markets rather than into areas that genuinely contribute to long-term economic development. When these bubbles burst, the resulting economic downturn can have severe repercussions, including loss of wealth, unemployment, and reduced economic activity. The distortion of competition is another significant consequence of the influx of illicit funds. Businesses that benefit from laundered money can afford to operate at lower costs or invest heavily in expansion, marketing, and product development. This advantage allows them to outcompete legitimate businesses that rely solely on legal financial resources. The uneven playing field created by the availability of laundered funds can drive honest entrepreneurs out of the market, reduce competition, and stifle innovation. Over time, this can lead to monopolistic or oligopolistic market conditions, where a few entities dominate, reducing consumer choice and potentially leading to higher prices and lower quality products and services. Furthermore, the availability of illicit funds can corrupt economic and political systems, leading to further inefficiencies. Laundered money can be used to bribe public officials, secure government contracts, or influence policy decisions, skewing them in favor of those with access to these funds. This corruption undermines the principles of fair competition and meritocracy, eroding trust in public institutions and the rule of law. It can also lead to the implementation of policies that favor certain sectors or businesses, regardless of their economic viability or contribution to the public good, further distorting resource allocation and economic development. The broader societal impact of economic inefficiencies caused by illicit funds is profound. They can exacerbate income inequality, as wealth generated through illegal means tends to concentrate among a small group of individuals or entities. This concentration of wealth not only increases social inequality, but also reduces social mobility, as opportunities for economic advancement become limited to those with access to illicit capital. This can lead to social unrest, reduced consumer confidence, and decreased overall economic productivity. Addressing the economic inefficiencies caused by money laundering and the influx of illicit funds requires a multifaceted approach. Governments and regulatory bodies must strengthen their anti-money laundering frameworks and enhance the monitoring of financial transactions, particularly in sectors prone to money laundering. This includes implementing stricter due diligence requirements for financial institutions, increasing transparency in financial and property markets, and enhancing international cooperation to track and recover illicit funds. In addition, there is a need for greater public awareness and education about the impacts of money laundering on the economy and society. By fostering a culture of compliance and ethical behavior in business practices, and by ensuring that businesses operate on a level playing field, it is possible to mitigate the negative effects of illicit funds on the economy. The economic inefficiencies caused by the influx of illicit funds have far-reaching implications for market stability, resource allocation, and societal well-being. Combating these inefficiencies requires concerted efforts from policymakers, regulators, businesses, and the public to ensure that economic activity is grounded in legality, fairness, and transparency. By addressing these challenges, we can promote a more equitable, efficient, and sustainable economic environment. Financial institutions that are found to be involved in money laundering activities face significant reputational risk, which can lead to a cascading series of negative consequences. Reputation is a crucial asset for banks, investment firms, and other financial entities, as it underpins their credibility, customer trust, and business relationships. When a financial institution is implicated in money laundering, whether through negligence, inadequate compliance measures, or intentional complicity, it can suffer severe reputational damage that undermines its standing in the market. One of the immediate impacts of such reputational damage is the loss of customer trust. Customers, both individual and corporate, expect financial institutions to adhere to high ethical standards and comply with legal and regulatory requirements. When these institutions are associated with money laundering, it erodes customer confidence, leading to a potential exodus of clients who seek more secure and reputable alternatives. The loss of customer trust can result in a significant reduction in deposits and investment inflows, which are critical for the institution's liquidity and profitability. In addition to losing customers, financial institutions implicated in money laundering can also face challenges in maintaining business relationships with other financial entities. Banks and financial firms rely on a network of correspondent banking relationships, partnerships, and alliances to provide a range of services, including international transactions, trade financing, and investment management. Reputational damage can strain these relationships, as other institutions may seek to distance themselves from a tainted partner to protect their own reputations and regulatory standing. This distancing can lead to the loss of critical business connections, reduced access to international markets, and difficulties in executing cross-border transactions. The impact of reputational risk extends to the institution's relationships with regulators and government authorities. Financial institutions are subject to stringent regulatory oversight, and being implicated in money laundering can trigger investigations, fines, and sanctions. Regulatory bodies may impose additional compliance requirements, increase monitoring, and even restrict the institution's operations. The heightened scrutiny can lead to increased operational costs, as the institution must invest in enhancing its compliance infrastructure, training staff, and implementing more robust monitoring systems. The financial burden of regulatory penalties and the costs associated with rectifying compliance deficiencies can further strain the institution's financial health. Reputational damage can also have long-term effects on the institution's brand value and market position. Negative publicity from money laundering scandals can tarnish the institution's image, making it less attractive to potential customers, investors, and employees. This tarnished image can hinder efforts to expand market share, launch new products, or enter new markets. In a highly competitive financial industry where reputation and trust are paramount, a damaged reputation can significantly hinder an institution's growth prospects and profitability. Moreover, the broader economic and societal implications of reputational risk should not be overlooked. Financial institutions play a crucial role in the functioning of the economy, facilitating transactions, providing credit, and supporting economic development. When an institution's reputation is compromised, it can erode public trust in the financial system as a whole. This erosion of trust can lead to broader financial instability as stakeholders question the integrity and stability of the financial sector. To mitigate reputational risk, financial institutions must prioritize robust anti-money laundering compliance programs. This includes implementing comprehensive customer due diligence procedures, transaction monitoring, and suspicious activity reporting. Institutions should also foster a culture of compliance and ethical behavior, ensuring that employees at all levels understand the importance of AML measures and the consequences of non-compliance. Engaging in proactive communication and transparency with customers, regulators, and the public is also essential in rebuilding trust and demonstrating a commitment to ethical conduct. The reputational risk associated with involvement in money laundering is a critical concern for financial institutions. The potential loss of customer trust, business relationships, regulatory challenges, and brand value can have far-reaching and long-lasting effects on the institution's operations and profitability. By implementing strong AML practices and maintaining high ethical standards, financial institutions can protect their reputations, uphold public trust, and contribute to the integrity and stability of the financial system. Banks and other financial entities are subject to a rigorous set of anti-money laundering regulations designed to prevent the laundering of illicit funds and ensure the integrity of the financial system. When these institutions fail to comply with AML regulations, they may face significant fines and sanctions imposed by regulatory authorities. These penalties can be substantial, reflecting the severity of the violations and the potential harm caused to the financial system and society. Regulatory fines for non-compliance with AML regulations can reach into the millions or even billions of dollars, depending on the scope and nature of the violations. These fines are often calculated based on factors such as the amount of money laundered, the duration of the noncompliance, and the extent to which the institution failed to implement adequate AML controls. In some cases, fines are compounded by the discovery of additional issues, such as failures in corporate governance, inadequate internal controls, or willful blindness to suspicious activities. The financial impact of these fines on banks and financial institutions can be profound. In addition to the immediate cost of the fines, which can erode profits and impact financial stability, institutions may also face increased operational costs related to enhancing their AML compliance programs. This includes investing in advanced monitoring systems, hiring specialized compliance personnel, and conducting extensive internal audits to identify and rectify deficiencies. The cumulative financial burden of fines and compliance improvements can be particularly challenging for smaller institutions or those already facing financial difficulties. Beyond the direct financial impact, regulatory fines can also result in sanctions that restrict the institution's operations. Regulatory authorities may impose conditions on the institution's license to operate, limit its ability to conduct certain types of business, or require periodic reporting and independent audits. In severe cases, regulators may revoke the institution's license, effectively shutting down its operations. These sanctions not only disrupt business activities, but can also damage the institution's reputation, erode customer confidence, and lead to the loss of business relationships with other financial entities. The consequences of regulatory fines and sanctions extend beyond the individual institution, affecting the broader financial sector and economy. Large fines and sanctions can signal systemic weaknesses in AML compliance within the financial system, prompting increased scrutiny and regulatory tightening across the industry. This can lead to higher compliance costs for all institutions, as regulators and financial entities work to shore up defenses against money laundering. Additionally, significant fines against major financial institutions can impact stock prices, investor confidence, and overall market stability. Regulatory fines for AML noncompliance also serve a critical deterrent function, sending a strong message to the financial industry about the importance of adhering to AML regulations. They underscore the seriousness with which regulators view AML violations and the commitment to holding institutions accountable for lapses in compliance. This deterrent effect is intended to encourage financial institutions to prioritize robust AML practices, invest in compliance infrastructure, and foster a culture of compliance within their organizations. Furthermore, the imposition of fines and sanctions often involves a degree of public disclosure, which can amplify the reputational impact on the institution. Publicly announced fines can attract media attention, highlight the institution's failings, and lead to negative perceptions among customers, investors, and the general public. This reputational damage can be long-lasting, affecting the institution's ability to attract and retain customers, secure funding, and compete in the market. To mitigate the risk of regulatory fines and sanctions, financial institutions must adopt a proactive approach to AML compliance. This includes implementing comprehensive AML policies and procedures, conducting regular risk assessments, and ensuring that all employees are adequately trained in recognizing and responding to potential money laundering activities. Institutions should also engage with regulators to stay informed about evolving AML requirements and best practices, ensuring that their compliance programs remain up to date and effective. Regulatory fines for failing to comply with AML regulations represent a significant risk for banks and financial entities. These fines not only impose substantial financial costs, but also carry the potential for operational disruption, reputational damage, and broader market implications. By prioritizing strong AML compliance practices and fostering a culture of ethical conduct, financial institutions can reduce their exposure to regulatory fines and contribute to the stability and integrity of the financial system. Laundered money frequently serves as the financial backbone for various criminal enterprises, funding activities that perpetuate a cycle of crime and violence. The availability of substantial financial resources allows criminal organizations to expand their operations, recruit more members, and invest in sophisticated technologies and weaponry. This escalation not only intensifies the scale and scope of criminal activities, but also contributes to a broader destabilization of communities and regions. One of the primary ways in which laundered money fuels increased crime is by supporting organized crime syndicates. These groups often engage in a wide range of illegal activities, including drug trafficking, human trafficking, arms smuggling, and extortion. The financial stability provided by laundered funds enables these organizations to diversify their criminal portfolios, spreading their influence and increasing their resilience against law enforcement actions. For example, a drug cartel might use laundered money to purchase drugs, pay for transportation and logistics, bribe officials, and secure new distribution channels. The expanded operation not only enhances the cartel's profitability, but also heightens the public health crisis associated with drug abuse and addiction. In addition to organized crime, laundered money can also fund terrorist activities. Terrorist groups often rely on a combination of legitimate and illicit funding sources to finance their operations, including recruiting, training, propaganda, and carrying out attacks. Money laundering allows these groups to move funds discreetly across borders, access international financial systems, and conceal the sources and destinations of their money. The ability to launder money effectively increases the operational capabilities of terrorist organizations, enabling them to execute more sophisticated and potentially devastating attacks. The proliferation of laundered money within the economy can also lead to an increase in violent crime. As criminal organizations grow in power and resources, they often resort to violence to protect their interests, eliminate rivals, and maintain control over territories and illegal markets. This violence can manifest in various forms, including gang wars, targeted killings, kidnappings, and intimidation tactics. The resulting environment of fear and insecurity not only affects the immediate victims, but also undermines community cohesion and trust in public institutions. The social and political consequences of increased crime due to laundered money extend beyond immediate violence. As criminal organizations entrench themselves within communities, they can corrupt local economies and governance structures. Laundered money can be used to bribe law enforcement officials, politicians, and public servants, leading to widespread corruption and eroding the rule of law. This corruption undermines public trust in government and judicial institutions, weakening the social contract and reducing citizens' willingness to engage with or rely on official channels for justice and services. Furthermore, the economic impact of crime fueled by laundered money can be devastating. Businesses may face extortion or protection rackets, increasing their operating costs and discouraging investment. Legitimate businesses may also struggle to compete with criminal enterprises that can undercut prices or use illicit funds to subsidize operations. This unfair competition can lead to job losses, reduced economic activity, and a decline in the quality of goods and services available to consumers. The increased crime associated with laundered money can also exacerbate social inequalities. Vulnerable populations, including those living in poverty or marginalized communities, are often disproportionately affected by crime and violence. These communities may lack access to adequate law enforcement protection and social services, leaving them more exposed to the impacts of criminal activities. The resulting social inequalities can fuel cycles of poverty, crime, and marginalization, creating an environment where criminal organizations can thrive and recruit new members. In response to the social and political consequences of increased crime driven by laundered money, governments and international organizations must prioritize robust anti-money laundering and counter-terrorism financing measures. This includes strengthening regulatory frameworks, enhancing law enforcement capabilities, and fostering international cooperation to track and disrupt financial networks that support criminal activities. Public awareness campaigns and community engagement initiatives can also play a crucial role in building resilience against crime and corruption. Laundered money not only perpetuates a cycle of crime and violence, but also has far-reaching social and political consequences. By funding criminal enterprises and undermining governance structures, it contributes to a destabilized and insecure environment. Combating the influence of laundered money requires a comprehensive and coordinated effort involving regulatory, law enforcement, and community-based approaches to protect the integrity and safety of societies worldwide. The availability of laundered money significantly facilitates corruption, which poses a profound threat to the rule of law and good governance. Corruption, fueled by illicit financial flows, can permeate various levels of government, law enforcement, and the private sector, creating a culture of impunity and weakening democratic institutions. The presence of laundered money exacerbates corruption by providing financial resources that can be used to bribe officials, manipulate political processes, and secure favorable outcomes in both the public and private sectors. One of the most direct ways in which laundered money contributes to corruption is through bribery. Criminal organizations, armed with substantial financial resources from money laundering activities, often use these funds to bribe public officials, law enforcement agents, and judicial authorities. These bribes can be used to secure contracts, licenses, or permits, influence policy decisions, or avoid prosecution and regulatory oversight. For instance, a construction company involved in money laundering may bribe local officials to win public contracts, outbidding legitimate competitors who cannot offer similar financial incentives. This practice not only distorts market competition, but also results in substandard public works projects that waste public resources and compromise safety. In the law enforcement and judicial sectors, corruption can have particularly damaging effects. Bribed officials may turn a blind eye to illegal activities, provide confidential information to criminals, or manipulate investigations and prosecutions to protect criminal interests. This undermines the rule of law, erodes public trust in justice institutions, and allows criminal organizations to operate with relative impunity. In extreme cases, entire law enforcement agencies or judicial systems may become compromised, creating a situation where the enforcement of laws becomes selective and arbitrary, benefiting those who can pay for protection or favorable treatment. The political landscape is also vulnerable to the corrupting influence of laundered money. Political campaigns and parties may receive illicit funding from individuals or organizations seeking to influence policy decisions or gain access to government resources. This can lead to the election of officials who are beholden to criminal interests, undermining democratic processes and governance. The ability of laundered money to shape political outcomes is particularly concerning in emerging democracies or countries with weak institutional checks and balances, where the influence of illicit financial flows can disproportionately affect governance and policymaking. Corruption facilitated by laundered money extends beyond the public sector into the private sector. Businesses may engage in corrupt practices, such as bribing regulatory bodies to avoid compliance costs, gain competitive advantages, or secure lucrative contracts. This undermines fair business practices and can lead to the proliferation of crony capitalism, where business success is more dependent on political connections and corrupt practices than on innovation and competitiveness. The resulting market distortions can stifle entrepreneurship, deter foreign investment, and slow economic growth. The social consequences of corruption fueled by laundered money are equally concerning. When public funds are diverted through corrupt practices, essential services such as healthcare, education, and infrastructure development suffer. This diminishes the quality of life for citizens, particularly the most vulnerable, and exacerbates social inequalities. Corruption also erodes public trust in government and institutions, fostering cynicism and disengagement among the populace. This lack of trust can hinder civic participation and weaken the social fabric, making it more difficult to address other societal challenges. Addressing the corruption enabled by laundered money requires a multifaceted approach. Governments must strengthen legal and regulatory frameworks to ensure transparency, accountability, and integrity in both the public and private sectors. This includes implementing stringent anti-corruption laws, enhancing the independence and capacity of anti-corruption agencies, and protecting whistleblowers who expose corrupt practices. International cooperation is crucial, as corruption and money laundering are often transnational in nature. Global initiatives and agreements, such as those promoted by the United Nations and the Financial Action Task Force, play a key role in harmonizing anti corruption and anti money laundering efforts across borders. Furthermore, promoting a culture of integrity and ethics within organizations is essential. This involves not only enforcing compliance with laws and regulations, but also fostering values of transparency, honesty, and public service. Education and public awareness campaigns can help build a societal consensus against corruption and encourage citizens to demand accountability from their leaders and institutions. The availability of laundered money greatly facilitates corruption, undermining the rule of law, good governance, and economic fairness. Combating this issue requires a coordinated effort involving legal reforms, robust enforcement, international cooperation, and a societal commitment to integrity and transparency. By addressing the root causes and mechanisms of corruption, it is possible to strengthen democratic institutions, promote economic development, and enhance social well-being. To combat money laundering, international bodies and national governments have implemented various measures. Anti-money laundering regulations are a critical component of the global effort to combat the illicit flow of funds through the financial system. These regulations are designed to prevent financial institutions from being used as channels for money laundering and to detect and report suspicious activities that may indicate money laundering or other financial crimes. The implementation of AML regulations involves several key requirements that financial institutions must adhere to, ensuring that they play a proactive role in safeguarding the financial system. One of the core components of AML regulations is the requirement for financial institutions to conduct customer due diligence. This process involves verifying the identity of customers, understanding the nature of their business, and assessing the risk they may pose in terms of money laundering or terrorist financing. Customer due diligence is crucial for establishing a customer's financial profile, which includes the source of their funds and the nature of their transactions. This information helps financial institutions identify any unusual or suspicious activities that may warrant further investigation or reporting. There are different levels of customer due diligence, depending on the perceived risk associated with a particular customer or transaction. Standard due diligence is applied to all customers and involves basic identity verification and information collection. However, in cases where the customer or transaction is deemed high risk, such as those involving politically exposed persons, individuals from high-risk countries, or complex corporate structures, financial institutions must conduct enhanced due diligence. Enhanced due diligence involves more rigorous checks and may include additional scrutiny of the customer's background, the nature and purpose of their business relationships, and ongoing monitoring of their account activity. Another critical element of AML regulations is the requirement to report suspicious transactions. Financial institutions are obligated to monitor transactions and flag those that deviate from a customer's normal behavior or that exhibit characteristics commonly associated with money laundering. These characteristics may include large cash deposits or withdrawals, rapid movements of funds between accounts, the use of multiple accounts for no apparent legitimate reason, or transactions that lack a clear economic or lawful purpose. When such suspicious activities are identified, financial institutions must file suspicious activity reports with relevant authorities, such as financial intelligence units, which analyze these reports and coordinate with law enforcement agencies to investigate potential financial crimes. In addition to customer due diligence and reporting requirements, AML regulations mandate that financial institutions maintain detailed records of transactions and customer information. These records are essential for tracking the flow of funds and providing a paper trail that can be used in investigations and audits. Record-keeping requirements typically specify that institutions must retain customer identification records, transaction histories, and documentation related to their due diligence processes for a specified period, often 5 to 10 years. This archival of records ensures that sufficient information is available for retrospective analysis, helping authorities uncover patterns of suspicious activity and build cases against money laundering networks. To ensure compliance with AML regulations, financial institutions must implement robust internal controls and compliance programs. This includes establishing clear policies and procedures, appointing dedicated AML compliance officers, and providing regular training for employees on the identification and reporting of suspicious activities. Institutions must also conduct regular audits and reviews of their AML programs to ensure they are effective and up to date with the latest regulatory requirements and industry best practices. The global nature of finance and the threat posed by money laundering necessitate a high degree of international cooperation and coordination among regulatory bodies, financial institutions, and governments. International organizations, such as the Financial Action Task Force, play a key role in setting global AML standards and promoting best practices. FATF's recommendations serve as a benchmark for national AML legislation and help harmonize regulations across jurisdictions, making it more difficult for criminals to exploit regulatory gaps or move illicit funds across borders undetected. Moreover, AML regulations are continually evolving in response to emerging threats and changes in the financial landscape. The rise of digital currencies, online banking, and financial technology innovations presents new challenges and opportunities for AML enforcement. Regulators are increasingly focusing on incorporating advanced technologies such as artificial intelligence and machine learning into AML systems to enhance the detection and prevention of money laundering activities. Anti-money laundering regulations are a vital element of the global effort to combat financial crime. By requiring financial institutions to conduct customer due diligence, report suspicious transactions, and maintain comprehensive records, these regulations help safeguard the integrity of the financial system. Effective implementation of AML regulations requires a coordinated effort among regulatory bodies, financial institutions, and international organizations, ensuring that the global financial system remains secure and resilient against the threats posed by money laundering. Know Your Customer policies are fundamental components of the regulatory framework designed to prevent money laundering, terrorist financing, and other financial crimes. These policies require banks and other financial entities to verify the identity of their clients as part of a broader effort to ensure that financial transactions are transparent and traceable. By implementing robust KYC procedures, financial institutions can prevent anonymous transactions that may facilitate illicit activities and protect themselves from being used as conduits for illegal funds. KYC policies typically involve a series of steps and processes aimed at confirming the true identity of clients and understanding the nature of their financial activities. One of the first steps in the KYC process is customer identification, where financial institutions are required to collect and verify basic information about their clients. This information generally includes personal details such as name, date of birth, address, and nationality, as well as identification documents like passports, driver's licenses, or national ID cards. The process may also involve validating these documents through external databases or verification services to ensure their authenticity and accuracy. In addition to identifying individual clients, KYC policies also extend to corporate clients and entities. In these cases, financial institutions must identify the legal structure of the company, including its ownership and control hierarchy. This involves understanding the business's nature and purpose, verifying the identities of beneficial owners, and ensuring that the business's operations align with its stated activities. For corporations, beneficial ownership information is particularly important as it helps reveal the ultimate individuals who own or control the company, preventing the use of complex structures or shell companies to obscure illegal activities. Once initial identification is complete, KYC policies also require financial institutions to conduct ongoing monitoring and due diligence throughout the client relationship. This continuous monitoring involves assessing transactions and account activities to identify any unusual or suspicious behavior that may indicate money laundering or other illicit activities. For example, a sudden increase in transaction volume, frequent large cash deposits, or transfers to high-risk jurisdictions may trigger further investigation and potentially the filing of a suspicious activity report. Enhanced due diligence is a critical component of KYC for high-risk clients or transactions. Financial institutions are expected to apply EDD measures in situations where there is a greater risk of money laundering or terrorist financing. This includes clients who are politically exposed persons, clients from high-risk countries, or those involved in complex or large transactions. Enhanced due diligence may involve more stringent verification processes, detailed inquiries into the source of funds, and closer scrutiny of transaction patterns. The importance of KYC policies extends beyond individual institutions to the integrity of the global financial system. By ensuring that financial entities have a clear understanding of their clients' identities and financial behaviors, KYC policies help prevent the infiltration of the financial system by criminals and terrorists. They also facilitate compliance with international sanctions regimes by identifying individuals and entities that may be subject to sanctions and ensuring that these parties cannot use the financial system to further their illegal activities. KYC policies are also crucial for preventing identity theft and financial fraud. By verifying customer identities and monitoring account activities, financial institutions can detect and prevent fraudulent activities, such as account takeovers, unauthorized transactions, and the use of stolen or falsified identification documents. This not only protects the institutions and their clients, but also upholds the broader security and trustworthiness of the financial system. In recent years, the implementation of KYC policies has been enhanced by advancements in technology. Financial institutions are increasingly using digital identity verification tools, biometrics, and artificial intelligence to streamline the KYC process and improve accuracy. These technologies enable institutions to verify identities more efficiently, detect anomalies in real time, and reduce the risk of human error. However, the reliance on technology also brings challenges, such as ensuring data privacy and security, as well as maintaining compliance with varying regulatory standards across different jurisdictions. Compliance with KYC requirements is not without challenges for financial institutions. The need to balance thorough customer due diligence with providing a seamless customer experience can be complex, particularly in an increasingly digital and globalized market. Moreover, the regulatory landscape for KYC is continually evolving, requiring institutions to stay updated with changes in legislation and best practices to avoid penalties and reputational damage. Know your customer policies are essential tools for financial institutions to prevent financial crimes and ensure the integrity of the financial system. By requiring thorough verification of client identities and continuous monitoring of account activities, KYC policies help mitigate the risks associated with money laundering, terrorist financing, and fraud. The effective implementation of KYC policies requires a combination of rigorous procedures, advanced technologies, and a commitment to compliance and ethical practices. As the financial landscape continues to evolve, KYC policies will remain a cornerstone of the global fight against financial crime. The Financial Action Task Force is an influential intergovernmental organization that plays a central role in the global fight against money laundering, terrorist financing, and other related threats to the integrity of the international financial system. Established in 1989 by the Group of Seven Nations, the FATF was created in response to growing concerns about the increasing misuse of financial systems by criminals and terrorists. Today, the FATF comprises 39 member jurisdictions and several regional organizations, representing a broad coalition of countries committed to combating financial crime. At the heart of the FATF's mission is the development and promotion of a comprehensive set of international standards known as the FATF recommendations. These recommendations, currently numbering 40, provide a framework for national laws and regulations aimed at preventing money laundering and the financing of terrorism and proliferation. The FATF recommendations cover a wide range of areas, including customer due diligence, record keeping, suspicious transaction reporting, international cooperation, and transparency in financial institutions and corporate entities. The FATF recommendations are designed to be adaptable and applicable to different legal, cultural, and economic systems, ensuring that they can be implemented effectively across diverse jurisdictions. However, they are also intended to be robust and comprehensive, addressing all stages of the money laundering and terrorist financing process. This includes preventive measures, such as customer due diligence and internal controls, as well as measures to detect and report suspicious activities, enforce compliance, and facilitate international cooperation. In addition to setting standards, the FATF is actively involved in monitoring and evaluating the implementation of its recommendations by member countries. This is done through a rigorous process known as the Mutual Evaluation Mechanism, where each member country's AML CFT, or known as Anti-Money Laundering and Counter-Terrorist Financing Framework, is assessed by a team of experts from other member countries. These evaluations assess both the technical compliance of national laws and regulations with the FATF standards and the effectiveness of their implementation in practice. The results are published in detailed reports, which include ratings, recommendations for improvement, and best practices. The mutual evaluation process is a powerful tool for promoting accountability and encouraging countries to strengthen their AML CFT measures. Countries that are found to have significant deficiencies may be subject to increased monitoring and follow-up processes, and in severe cases, they may face public statements or sanctions. The FATF also maintains a list of high-risk and non-cooperative jurisdictions, commonly known as the FATF Blacklist and Gray List, which identifies countries with strategic AML CFT deficiencies that pose a risk to the international financial system. Being listed can result in enhanced scrutiny from the global financial community and potential countermeasures from other jurisdictions. Beyond its standard-setting and monitoring roles, the FATF engages in capacity building and outreach activities to support countries in improving their AML-CFT frameworks. This includes providing technical assistance, training, and guidance to help countries understand and implement the FATF recommendations effectively. The FATF also works closely with regional bodies, known as FATF-style regional bodies, which help to promote and implement FATF standards in their respective regions. The FATF's work is supported by extensive research and analysis on emerging trends and threats in money laundering, terrorist financing, and proliferation financing. The organization regularly publishes reports and typologies that highlight new methods and techniques used by criminals and terrorists, as well as best practices and innovative approaches to combating these threats. This research helps to inform the development of new standards and the refinement of existing ones, ensuring that the FATF recommendations remain relevant and effective in a rapidly changing financial landscape. International cooperation is a cornerstone of the FATF's efforts, as money laundering and terrorist financing are inherently global challenges that require coordinated responses. The FATF fosters collaboration among its members and with other international organizations, including the United Nations, the International Monetary Fund, the World Bank, and various law enforcement agencies. Through these partnerships, the FATF seeks to enhance the global AML-CFT framework, promote the harmonization of standards, and facilitate the exchange of information and best practices. The Financial Action Task Force is a vital institution in the global effort to combat money laundering and terrorist financing. Through its standard setting, monitoring, and capacity building activities, the FATF promotes the implementation of effective measures to protect the integrity of the international financial system. As the financial landscape continues to evolve, the FATF's role in identifying and responding to emerging threats, fostering international cooperation, and driving improvements in national and global AML-CFT frameworks remains essential. Mutual legal assistance is a crucial mechanism that facilitates international cooperation in the investigation and prosecution of money laundering and other cross-border financial crimes. As these crimes often involve complex networks that span multiple jurisdictions, effective collaboration between countries is essential to dismantle these networks, gather evidence, and bring perpetrators to justice. MLA provides a formal process through which countries can request and provide assistance in legal matters, including the sharing of information, evidence, and resources. The process of mutual legal assistance typically begins with a formal request known as a mutual legal assistance request, submitted by one country to another. This request outlines the nature of the assistance needed, the specific actions to be taken, and the legal basis for the request. Common forms of assistance requested include the identification and freezing of assets, the gathering of financial records, witness statements, and the service of legal documents. These requests are often governed by bilateral or multilateral treaties, agreements, or conventions, which outline the procedures and obligations of the countries involved. One of the key challenges in combating money laundering is the ability to trace and recover assets that have been moved across borders. Mutual legal assistance plays a vital role in this area by enabling countries to locate, freeze, and eventually seize illicit assets held in foreign jurisdictions. This process requires a high level of coordination and trust between the requesting and responding countries, as well as compliance with domestic and international legal standards. Asset recovery is a critical aspect of justice as it deprives criminals of the proceeds of their crimes and serves as a deterrent to future criminal activities. In addition to asset recovery, MLA is essential for the collection of evidence needed to build strong cases against individuals and organizations involved in money laundering. This includes accessing financial records, transaction data, and other relevant documents that may be held in different countries. The ability to obtain such evidence is crucial for establishing the flow of illicit funds, identifying the parties involved, and proving the criminal nature of the activities. Cooperation through MLA also facilitates the interviewing of witnesses and the taking of depositions, which can be vital for corroborating evidence and providing a comprehensive picture of the criminal enterprise. Mutual legal assistance is not limited to the pre-trial investigation phase. It also extends to the prosecution and adjudication stages of criminal proceedings. This includes the extradition of suspects and convicted individuals to face charges or serve sentences in the requesting country. Extradition requests are often part of broader MLA agreements and are governed by international treaties that stipulate the conditions and procedures for the transfer of individuals. These treaties ensure that suspects are afforded due process rights and that the principle of double criminality, meaning the alleged offense must be a crime in both countries, is respected. The effectiveness of mutual legal assistance depends on several factors, including the strength of the legal frameworks in place, the efficiency of the judicial and law enforcement systems, and the level of political will and cooperation between countries. In some cases, differences in legal systems, standards of evidence, and procedural requirements can pose challenges to the MLA process. To address these challenges, many countries and international organizations work to harmonize legal standards and practices, enhance communication channels, and provide technical assistance to strengthen the capacity of national authorities to handle MLA requests. International organizations such as the United Nations, the Financial Action Task Force, and the International Criminal Police Organization, known as Interpol, play a pivotal role in promoting and facilitating mutual legal assistance. They provide guidelines, model treaties, and best practices to help countries establish and implement effective MLA frameworks. These organizations also foster dialogue and collaboration through conferences, workshops, and training programs, helping to build networks of cooperation and trust among law enforcement and judicial officials worldwide. Mutual legal assistance is particularly crucial in the context of transnational organized crime and terrorism financing, where the ability to disrupt global criminal networks depends on the effective coordination of actions across multiple jurisdictions. The complex nature of these crimes requires a comprehensive and integrated approach, involving not only the sharing of information and evidence, but also coordinated operational actions, such as joint investigations and simultaneous enforcement operations. Mutual legal assistance is a cornerstone of international cooperation in the fight against money laundering and other serious crimes. By providing a formal mechanism for countries to request and provide legal assistance, MLA enhances the ability of law enforcement and judicial authorities to investigate and prosecute criminal activities that cross borders. The success of MLA efforts depends on strong legal frameworks, effective communication and cooperation, and the ongoing commitment of countries to uphold the rule of law and international justice. As financial crimes continue to evolve and become more sophisticated, the importance of mutual legal assistance in safeguarding the global financial system and maintaining international security cannot be overstated. Transaction monitoring systems are a critical component of anti-money laundering efforts within financial institutions. These systems use sophisticated software to analyze financial transactions for suspicious patterns that may indicate money laundering or other illicit activities. By automating the monitoring process, these systems enable financial institutions to efficiently process large volumes of transactions, identifying potential risks and ensuring compliance with regulatory requirements. Transaction monitoring systems work by applying a set of predefined rules and algorithms to transaction data, scrutinizing various aspects such as transaction amounts, frequency, the origin and destination of funds, and the types of transactions conducted. These rules are based on known indicators of money laundering, such as large cash deposits, rapid movement of funds across different accounts, or transactions involving high-risk jurisdictions. The systems also consider customer profiles and historical transaction data, allowing for the identification of deviations from established patterns of behavior that may warrant further investigation. One of the key features of transaction monitoring systems is their ability to flag suspicious activities in real time or near real time. When a transaction triggers an alert, it is typically reviewed by compliance officers or analysts who assess whether the activity is genuinely suspicious or can be explained by legitimate factors. This review process often involves gathering additional information, such as the purpose of the transaction, the relationship between the parties involved, and any relevant documentation. If the activity is deemed suspicious and cannot be adequately explained, the financial institution may file a suspicious activity report with relevant regulatory authorities. The use of transaction monitoring systems is essential for maintaining compliance with AML regulations, which require financial institutions to take proactive measures to prevent and detect money laundering. By providing a systematic and consistent approach to monitoring transactions, these systems help institutions meet their legal obligations and reduce the risk of regulatory penalties. Additionally, they play a crucial role in protecting the institution's reputation by demonstrating a commitment to preventing financial crime. The effectiveness of transaction monitoring systems depends on the quality of the data inputs, the robustness of the algorithms and rules used, and the expertise of the personnel involved in the review process. Financial institutions must ensure that their systems are regularly updated to reflect new and emerging risks, changes in regulatory requirements, and advancements in money laundering techniques. This includes incorporating artificial intelligence and machine learning technologies, which can enhance the system's ability to detect complex patterns and adapt to evolving threats. AI and machine learning technologies offer several advantages for transaction monitoring systems. These technologies can analyze vast amounts of data at high speed, identifying subtle patterns and correlations that may be missed by traditional rule-based systems. For example, machine learning algorithms can learn from historical data to improve the accuracy of alerts, reducing false positives, and helping compliance teams focus on genuinely suspicious activities. AI-driven systems can also continuously refine their models and rules, adapting to new types of financial crime and improving detection capabilities over time. The integration of AI and machine learning into transaction monitoring systems also facilitates the use of advanced analytics, such as predictive modeling and anomaly detection. Predictive models can identify transactions that, based on historical trends, are likely to be associated with money laundering. Anomaly detection techniques can highlight unusual or unexpected behaviors, such as a sudden spike in transaction volume or the use of unusual payment methods, which may indicate suspicious activity. These advanced analytics provide financial institutions with deeper insights into potential risks and enhance their ability to respond proactively to emerging threats. Despite the benefits of transaction monitoring systems, challenges remain in ensuring their effectiveness. One of the primary challenges is the issue of false positives, where legitimate transactions are incorrectly flagged as suspicious. High rates of false positives can overwhelm compliance teams, diverting resources from investigating genuine threats and potentially damaging customer relationships. To address this, financial institutions must continuously refine their monitoring systems, calibrating rules and algorithms to balance the need for thorough oversight with the efficiency of the review process. Another challenge is the integration of data from different sources and systems, particularly in large or multinational financial institutions. Effective transaction monitoring requires access to comprehensive and accurate data, including customer information, transaction histories, and external data sources such as sanctions lists and public records. Ensuring data quality and consistency across different platforms and jurisdictions is critical for accurate risk assessment and decision-making. Furthermore, the global nature of financial transactions and the use of complex financial instruments add layers of complexity to transaction monitoring. Cross-border transactions, shell companies, and correspondent banking relationships can obscure the true origin and destination of funds, making it difficult to trace money flows and identify suspicious activities. Financial institutions must therefore invest in robust data integration and analytics capabilities, as well as foster international cooperation and information sharing with other institutions and regulatory bodies. Transaction monitoring systems are a vital tool for financial institutions in detecting and preventing money laundering and other financial crimes. By leveraging advanced technologies and analytics, these systems enable institutions to monitor transactions effectively, identify potential risks, and comply with regulatory requirements. However, the evolving nature of financial crime and the challenges of data integration and false positives necessitate continuous improvement and adaptation of these systems. As the financial landscape continues to change, transaction monitoring systems will remain a key component of the global effort to maintain the integrity of the financial system and protect against illicit activities. The rise of cryptocurrencies and blockchain technology has brought both challenges and opportunities to the realm of anti-money laundering efforts. Cryptocurrencies, such as Bitcoin, Ethereum, and others, have gained widespread popularity due to their decentralized nature, potential for high returns, and the promise of greater financial privacy. However, these same features can also pose significant challenges for AML measures, as they offer a degree of anonymity that can be exploited by criminals to facilitate money laundering, terrorist financing, and other illicit activities. One of the primary concerns with cryptocurrencies in the context of AML is the pseudo-anonymity they provide. While transactions on a blockchain are transparent and can be viewed by anyone, the identities of the individuals involved in the transactions are often obscured by cryptographic addresses. This makes it challenging to trace the ownership of funds, especially when combined with techniques such as mixing or tumbling, where cryptocurrencies are pooled together and then redistributed to obscure their origins. Additionally, some cryptocurrencies, known as privacy coins, e.g. Monero, Zcash, are specifically designed to enhance user privacy, making it even more difficult to trace transactions and link them to real-world identities. Despite these challenges, blockchain technology itself offers several features that can be leveraged to enhance AML efforts. Blockchain is a decentralized ledger that records all transactions in a secure, transparent, and immutable manner. This inherent transparency and traceability provide a valuable tool for regulators and law enforcement agencies in the fight against financial crime. Every transaction recorded on a blockchain is permanent and can be traced back through the entire history of the cryptocurrency, allowing for the identification of suspicious patterns and the reconstruction of transaction chains. The traceability offered by blockchain technology can be particularly useful in identifying and investigating complex money laundering schemes. For instance, blockchain analysis tools can be used to monitor large transactions, identify clusters of related addresses, and detect unusual patterns of behavior. These tools can also help law enforcement agencies track the flow of illicit funds across multiple transactions and jurisdictions, potentially leading to the identification of the individuals or entities involved. Moreover, the public nature of most blockchain networks provides an opportunity for enhanced regulatory oversight and compliance. Financial institutions, cryptocurrency exchanges, and other entities involved in the digital asset ecosystem can implement robust AML and Know Your Customer procedures, leveraging blockchain's transparency to verify identities and monitor transactions. By integrating blockchain analytics with traditional AML frameworks, these entities can improve their ability to detect and report suspicious activities, thereby enhancing overall financial security. To address the AML challenges posed by cryptocurrencies, regulators and policymakers worldwide are increasingly focusing on creating and enforcing regulations specifically tailored to the digital asset space. This includes the implementation of KYC requirements for cryptocurrency exchanges and wallet providers, mandating that these entities verify the identities of their users and maintain records of transactions. Additionally, many jurisdictions are adopting or proposing regulations that require exchanges to implement robust transaction monitoring systems, report suspicious transactions, and cooperate with law enforcement investigations. The Financial Action Task Force, an intergovernmental organization that sets global standards for AML and counter-terrorist financing, has issued guidelines and recommendations for the regulation of virtual assets and virtual asset service providers. These guidelines emphasize the importance of risk-based AML CFT measures, including customer due diligence, record keeping, and reporting obligations. The FATF's guidance also highlights the need for international cooperation and information sharing, given the cross-border nature of cryptocurrencies and blockchain technology. In response to these regulatory developments, the cryptocurrency industry is seeing the emergence of RegTech solutions that specialize in compliance for digital assets. These solutions often incorporate advanced analytics, artificial intelligence, and machine learning to enhance the detection of suspicious activities and streamline compliance processes. For example, blockchain forensics firms provide services such as transaction monitoring, risk assessment, and identity verification, helping exchanges and other stakeholders meet regulatory requirements and reduce the risk of financial crime. In addition to regulatory and industry initiatives, there is growing recognition of the need for public-private partnerships in addressing the challenges and opportunities presented by blockchain and cryptocurrencies. These partnerships can facilitate dialogue and collaboration between regulators, law enforcement agencies, industry participants, and technology providers, ensuring a coordinated and effective response to emerging risks. Such collaborations can also promote the development of best practices, standards, and technological innovations that enhance the security and integrity of the digital asset ecosystem. While cryptocurrencies and blockchain technology present significant challenges for AML efforts due to their potential for anonymity and global reach, they also offer unique opportunities for enhancing transparency, traceability, and regulatory oversight. By leveraging the strengths of blockchain technology and implementing robust regulatory frameworks, it is possible to mitigate the risks associated with digital assets and harness their potential for positive innovation. The continued evolution of AML practices, regulatory standards, and technological solutions will be critical in ensuring that the benefits of blockchain and cryptocurrencies can be realized while safeguarding the financial system against illicit activities. Money laundering is a complex and evolving challenge with significant implications for the global economy and security. Understanding the mechanisms behind criminal money and the laundering process is crucial for developing effective strategies to combat this illicit activity. As criminals continue to devise new methods to launder money, authorities and financial institutions must remain vigilant and adaptable, employing advanced technology and international cooperation to curb this pervasive threat.